morning. It's 8 minutes after 10 on a Friday. That means it's time for the Real Estate Fix. I'm your host, Rich Sherman. Thank you guys for tuning in today. We've got a fun show today. We always have fun shows. It's good stuff. Today we're going to do all the things. We're going to do a little market wrap-up stuff, and then we're going to do, kind of where the market's going, kind of how we're starting the year out here. Most of it's good news, but it's not all good news. It's sort of how where the market's at. We're going to go over that in a minute. And I also have special in-studio guest. I have Angela Wyckoff. She's a reverse mortgage specialist. And for those of you who listen to the show regularly, and you're poo-pooing this right now, I know I'm not a huge fan of reverse mortgages, but as we like to be a resource for you guys, it's always the object of the exercise. We fix things. We provide a resource for you, all things real estate. And I actually found a reverse mortgage lender who I like, who really seems to know what she's doing and has the right attitude about it. More than importantly, she's much more concerned with the client's needs than with her own. And that is a rare, rare thing in my business, true of realtors as well. Not, higher percentage you think who actually care about what they're doing, but not 100%. That's my problem. But anyway, so we're going to have that today. So it's going to be all things reverse mortgage. But first, let's talk about some market stuff. Good news and bad news as far as the market and the interest rate is concerned. As you guys know, the interest rate, we talk about this every week. The interest rate is kind of what governs where the market's going, what it's doing, how it's going to be. Lower interest rates are good for real estate, obviously. Higher interest rates are bad in general, although there are exceptions. And I was really hoping, that we were going to see interest rate come down a little bit more than it has. Right now, it's hovering between about 6.9 to 7.5, depending on the type of mortgage you're getting and what you're looking to do. We've had a lot of good luck. Those guys who listen to the show, you know that Sam Chong with the Mortgage Hub is one of the friends of the show, supports the show. And Sam's been getting us preferential rates for people ever since January 1st, where most people are a little over 7 with good credit and a decent down payment. He's been getting FHA people through at like 6.7, 6.6. It's been fantastic. So we're making up ground there. It's making it a little easier to afford houses. So let's talk about the bad news. The bad news, and this is going to sound a little strange, there are two reports that have come out in the last couple of weeks. One was about jobs, and the other was about consumer spending. And unfortunately for our position, for real estate, for the interest rate, both of those reports were in the positive. The jobs report came in, and we were hoping to be a little bit weaker, not catastrophic, but just a little bit weaker. And unfortunately, it was stronger than Wall Street had predicted. So that is not an indicator that the interest rate is going to come down. And more directly, the consumer spending numbers came out. Everybody expected consumer spending to go up. Not only a little bit, the projections from Wall Street that were coming in universally were sort of like 0.4%, something like that, and instead it came in at 0.6%, which made Wall Street freak out a little bit, and it did indicate that the Fed is probably not going to lower the interest rate the way we would like. But I do want to read you some stuff from the Fed's last meeting on December 13th. I think it was pretty interesting stuff. On December 13th, the Fed had held its key interest rate steady at 5.5%. Now that's the Fed's interest rate. That is not the mortgage interest rate. The mortgage interest rate feeds off of that, but it's usually about 1.5 to 2 points higher than the Fed's rate. And that rate for a long, long time was down at 0 or near 0. So the fact that it's at 5.5 is what's causing us the problem that we're having. So anyway, it's 5.5% Fed interest rate for the third consecutive meeting. Powell announced, quote, very good news that, quote, inflation has eased from its highs and without significant increase in unemployment. Since March of 2022, the Fed has hiked interest rates 11 times. The Fed's initial interest rate in 2022 in March was 0.25%. Now it's jumped to 5.5%. So that's a lot. Now, they did it to tame inflation. This aggressive action, while painful for U.S. consumers and it has increased the cost of borrowing, has lately coincided with a falling inflation rate from 8.5 to 3.1. Now, a 3.1 inflation rate I think is pretty good. I think most people would agree. I think most economists would agree with that. But the Fed has this idea that I just cannot get behind, that they need the inflation rate at 2%. And I just don't know that we're going to get there, and I don't really want to have to go through the pain we're going to have to get anywhere near it, because that is an indicator the rates are going to stay a little bit higher than we would like. So, quote, while we believe that our policy rate, this is from Jerome Powell, while we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We're committed to achieving a stance of monetary policy that's sufficiently restrictive to bring inflation stability down to 2% over time and keep policy restrictive until we're confident that inflation is on a path to that objective. I think considering that we were 8.5% inflation rate only, a year ago, a little 2 years ago, I guess, and we're down to 3.1 now, I'd say it's on that track. I don't think it needs to be goosed anymore. I think what the Fed is doing now is not deflating inflation. I think it's causing it. But that being said, the member of the Fed Open Market Commission, the FOMC, F-O-M-C, suggested that there could be at least 3 interest rate cuts in 2024. On the news of this, the Dow Jones Industrial Average gained 510 points, or 1.04%, to close at 37,090.24, an all-time high. Meanwhile, the S&P 500 climbed 1.37%, and the Nasdaq Composite jumped 1.38%. All three major averages hit a 52-week high on the on this news in mid-December. So when the Fed comes out and says, we don't think we're going to raise the interest rate anymore, and people go, well, I think you're going to drop it, the markets do really well. And that is a good thing, because when money stays in the stock market, although that is not a good indicator for interest rates necessarily, we'd like to see money running to the bond market, because that means investors are scared of the stock market, and that would cause interest rates to fall on its own. It's still fine. The market reaction to this was, look, you're not going to raise the interest rate, good times ahead. You are going to raise the interest rates, rough times ahead. So let's talk about what some of the other media outlets out there are saying, because it's important. As what the media says is often what manifests. Now, they're not always right, but if you say it loud enough and long enough, it tends to become right. So we need to pay some attention to that. So the 2024 housing market, according to Housing Wire on CNBC, mortgage rates are still restrictive enough to prevent existing home sales from growing. Listings will increase thanks in part to increased building of single-family homes, meaning more options. But overall, things are going to kind of stay status quo, at least for the first quarter. Now, my hope was at the beginning of the second quarter, we would start to see significant drops in the interest rate. I'd like to see us get below 6%. Our target would be about 5.5%. That seems to be where normality will be restored. Everything I'm reading, obviously lower is better, but 5.5 would get us where we need to go. And we're still about a point and a half away from that, give or take. So some might say 2, but so we need to get down to that. Now, what's helping a lot, these are numbers that are important because this has to do with new housing, which is a big part of real estate, obviously. We just simply don't have enough housing, especially in Southern California. So residential housing starts in December fell 4.3%. Single-family housing starts are down 8.6%. Now, those are national numbers. Building permits, however, and this is the good news, are up 1.9%. For single-family permits, the rose 1.7%. So builders are out there building single-family homes. They're building them all over the country, which is good. And builders are in a position to cut rates a little bit easier because they have a lot of preferential stuff with mortgage companies, so that works out well as well. There was one I saw the other day. I can't remember which builder it was, but they're offering you a 1% reduction on your mortgage across the board for the first year. So they're going to eat the difference for you. And then, of course, the second year it goes up. So you're either hoping the interest rate will go down or be ready for the higher payment 12 months in. But it is nice that they give you that 12-month respite. So let's see. Fox Business. That was what the good folks at CNBC had to say. According to Fox Business, Maria Bertolomo at the World Economic Forum in Davos, Switzerland, Davos, Switzerland, where we all summer, was speaking to Cantor Fitzgerald CEO Howard Lutnick, and he said, and this is, I pay attention to what these guys say, not because I like them or hate them, just because they're huge. Cantor Fitzgerald's a massive company, and what they say, it affects things. Anyway, Howard Lutnick, president of the company, CEO, said a generational shift is on the horizon, warning of a massive default in loan sales. I quote, I think $700 billion could default. The lenders are going to have to deal with things, are going to have to do things with them. They're going to be selling. It's going to be a generational change in real estate coming at the end of 2024 and all of 2025. We'll be talking about real estate being just massive changes, $700 billion to $1 trillion in defaults coming. So he sees a lot of foreclosure defaults coming. And I think he's talking about commercial as well. We can get that in a future show, but we are seeing more foreclosures for sure. The number of residential foreclosures in Southern California that we monitor, which is all 10 counties of Southern California, has spiked yet again. In January, it spiked here. So we're seeing, late December, it spiked. So what we're seeing is about a 20% rise in just foreclosure activity in those 10 counties that make up Southern California. Anyway, back to Fox Business. The CEO also revealed his candid assessment of the markets, warning people that are overly optimistic about the Federal Reserve and future interest rates. And this is the part that worries me. I think, according to Howard Lutnick here from Cantor Fitzgerald, I think rates are going to stay sort of steady Eddie. I think all of this talk of 170 basis point cuts, that's about a point and a half to you and me, that's just way too much. Way too much. I think it could be 50 basis points, maybe 75, but that's it. So I just think it's overdone. People are overly optimistic about rates. I think we're going to stay around here, but that's okay. The world is ready for steady. Well, I don't know about the world's ready for steady at 7%, thank you very much. I mean, if you're a multi-billionaire head of Cantor Fitzgerald, I'm sure it doesn't affect you as far as your house. But for those of us, mere mortals who have mortgage payments and mortgage statements, or worse yet, work in the real estate industry, it's kind of important to us. So I thank you for your opinion. I just don't necessarily agree. So to give a slightly different opinion, big real estate investor out of Florida. You see him all the time. If you watch the internet, if you watch YouTube at all, you'll see this guy all over the place. Gives some pretty good advice. I don't agree with all of it. Like, he thinks people shouldn't own houses. I certainly don't agree with that. His name is Grant Cardone, or Cardone. I've heard it pronounced both ways. We're going to go with Cardone today. Of Cardone Capital, said the U.S. is entering the greatest real estate correction of his lifetime. He went on to say the Fed has single-handedly killed the housing market. I agree with that. The Fed will make more renters in this country in the last two. The Fed has made more renters in this country let me rephrase. The Fed will make more renters in this country in the next 2 years than it has in the last 50 because mortgage applications are at all-time lows. In most places, mortgages are double what rent is today. The Fed has never really controlled inflation. Supply and demand does that. What the Fed has done was create inflation and destroy the housing industry. I could not agree with that statement more. I'm going to read it over again. The Fed has never really controlled inflation. Supply and demand does that. What the Fed has done was create inflation and destroy the housing industry. It's definitely not been a fun 2023, I'll tell you. The number of houses being sold, the number of ancillary businesses that are being jammed up as a result are way, way down, and I don't see that as helping the economy, but I'm not a member of the Fed. They don't ask me. Cardone went on to say that he thinks the Fed should just get out of the way and let the market do its thing. Couldn't agree more. When interest rates come down, mortgage applications go up, and people start selling their houses. What he's talking about is there's not enough stuff on the market, and he is 100% right. We just do not have enough houses on the market right now, and that is what is causing a lot of this, and a lot of it's frozen out. Because, and I keep repeating the statistic, I may just have to get a tattoo of this. No, don't worry about it, honey. I'm not getting a tattoo of this. My wife listens, and I don't need to call. Anyway, not that my mother doesn't listen, so she wouldn't know. Anyway, what I've been saying over and over again, and this is a shocking statistic to me. Fannie Mae and Freddie Mac, end of last year, released this. 70% of every single mortgage in the United States, every single residential mortgage, condos, houses, whatever, residential mortgages, 70% of them have an interest rate at or below 4% because of the low interest rates we had through COVID. Now, there's an additional 15%, so 85% have mortgage rates at or below 5%. So that means 85% of the market is essentially locked in with what they're calling golden handcuffs. Because if you have a 4 or 5% interest rate or lower, you're not going to be anxious to sell your house and get into a 7% interest rate or 6.5% interest rate. Your payment's going to go way, way, way up, and your spending power goes way, way down. That is just the nature of rising interest rates, and that is a problem, or risen interest rates. Now, it's good that the interest rate isn't going up anymore, and I think it's starting to relax, which is a good thing, but we need it to come down more. We need to hit that 5.5. And the more I read, the more I study this, I'm convinced that normality will return once we get to 5.5. And until or unless we get to 5.5 as the median interest rate for a 30-year fixed mortgage in the United States, we are going to continue to have restricted inventory, and we're going to continue to have problems. People will make the jump from 4% to 5.5% if it's a bigger, better house. They'll certainly make the jump from 5.5% to 5.5% if they're already there. And that is just going to be the magic number, and that is what we need to hit. And that's not just my opinion. If you take a look at most of the economists, especially the real estate-focused economists at Adam and places like that, CoreLogix and others, they're all singing the same tune. We need to get under 6. Most of them in press will say 5.5 is where we need to be, and we're still a ways away from that, folks. So we're going to still in choppy waters as far as the real estate business is concerned going forward. So that's kind of where we're at. So I keep saying this: if you have a house to sell and you don't have to buy one, this is your market. If you are selling a house to move to a foreign country or whatever you're doing, fantastic. God bless. This is your market. But if you have a house to sell and you're going to buy another one, that's going to be problematic. Or if you're getting into the market for the first time, you're a first-time buyer and you're looking to buy a house, something we do a lot in my office because it's fun. It's fun to be part of first people buying their first house. It's like being part of a wedding, like part of being a wedding planner or something. You get to be part of somebody's, there aren't too many first-time things in a lifetime you go through, and it's fun to be part of that with folks, so whenever we can. But anyway, if you're a first-time buyer, it's even harder because your affordability just went down. I've been saying this now all year. Affordability, affordability, affordability. That is the key word. Those are the 3 key words in real estate. They were in 2023, they will be in 2024, and they will still be in 2025 because the interest rate has got to come under control. So that's where we're at. And if you're ever having a problem with real estate, you got a house to sell, you got something else going on, a house to buy, whatever. If you have any issues, you can always give me a call. I'm happy to help. It's a really fun issue. Might even bring it up on the show with your permission, of course. So if you have any questions for me or anything else going on, you can always reach me. This is my private cell phone number. I hand it out on the air all the time, 661-714-1400. That number again is 661-714-1400. You can also get me through the station. You can find me online. I'm pretty easy to find. I have a unique last name. It's spelled Szerman. There's a Z where the H should be. It's pronounced Sherman, but it's spelled Zerman because, I don't know, Russian, Polish ancestry, they tell me, or maybe they're just making it up. Maybe we just put the Z in there for fun because we had, wanted to be able to trace telemarketers who can't pronounce my name. But I'm easy to find, so give me a call anytime. I'll be happy to help. So I tell you what, why don't we go to break? We'll hear from some of our wonderful advertisers, one of our supporters. And when we come back, we're going to be talking to Angela Wyckoff about all things reverse mortgage. And you guys are going to like this. It's going to be good stuff. Stay with me through the break, and I'll be right back. Hi, guys. Thank you. Welcome back. Thank you for listening. Thank you for hanging out through the commercials. We appreciate that. Here today, I got a special guest in studio, as promised, with Angela Wyckoff. We're going to talk about all things reverse mortgage. It'll be good stuff for you guys. Now, you know that I'm not the biggest fan of reverse mortgages. I get this all the time because I only talk about these things when they've gone wrong. And I say this all the time, but this part seems to get muddled. I am not necessarily against reverse mortgages. I'm really not. I think they're a pretty decent financial option for a lot of people. I think a lot of people need to use them, and I said that even when I'm complaining about them, I say that. My issue with reverse mortgages is not the concept and it's not the origination of them. It's the way that there are just some bad actors, as there are with every mortgage product, who just don't do this job right. I'm talking to you, Carrington Mortgage and PHH. Both of you guys are clowns. because they have the scam that they run and they take advantage of people. Now, we undo that, and we do it very successfully, pretty, all the time, because when you catch somebody doing that, they back off. But there are issues with them, but that's because of bad actors. That is not because the product itself is inherently flawed in any way, shape, or form. My mother has a reverse mortgage, so I'm not against them in any way, shape, or form. And when you think about, I've quoted this before, but there's an AARP study that was done just before the pandemic where they concluded that, according to their survey, it was a good-sized survey, too, and there was 10,000 people. It was a big survey for them. But anyway, they concluded that, I think it was 98% of everyone surveyed said they have to use the equity they've built in their home in order to be able to retire. 98%. You may as well be 100. They need the equity in their home to retire. I suspect that'll be the same for me. I think it's the same for most people, especially in Southern California, where the numbers here are so expensive to live here. If you have not built up that equity over time, you're going to have a problem retiring, because I'm here to tell you, Social Security is not going to get it done. It's just not. So you're going to need the equity in your house. So a reverse mortgage is a good way to tap that equity. And again, if you're with a reputable reverse mortgage company, you're not going to have a problem. We don't get problems from Mutual of Omaha and some of these other people who do a lot of reverse mortgages. We get problems from, I'll probably get in trouble for saying this, but the bottom feeders like PHH and Carrington and guys like that, because they take what was an honest, usable product and they pervert it for their own needs. And that's not just reverse mortgages. Carrington does that with other things as well. Gregory Funding does that with other things as well. If they can take advantage of you, they will. But again, that's not the fault of the product. That is not the fault of the design of the product. That is not the fault of the origination of the product. And at the end of the day, there's some people, like my mom, who just need that to survive. So that's the end of my speech on reverse mortgages. It's just you guys only tend to hear these stuff when I've got a client who's having a problem that we bring into the show and we talk about the problem. We get use the forum that we've built here to get it done. So this is not that. I wanted to actually bring somebody where I didn't have to whine about stuff constantly. I actually had somebody I could bring in and say, look, this is a positive solution here. So if you are looking for a reverse mortgage, we get a lot of calls about that. I recently met Angela, and we talked about reverse mortgages. She was highly recommended, and we were talking about it. And she has the right attitude about it. She clearly cares more about her clients than she does for feathering her own nest, which is kind of the point, because that's always how these things are supposed to work. So, all that being said, with my little introduction now underway, and I've sort of got everybody set now. Audience, meet Angela. Angela, audience, say hi.
Hey, Rich. Thanks for having me. Hey, everybody. I am happy to be here today and talk about reverse mortgage and the myths
there are a lot
around it.
And as always, guys, I've been collecting up questions. Angela sent me some as well that she gets all the time. And we've been collecting up questions. We put it in little groups. We're going to go through some little question and answer here to kind of get started, and we'll sort of go from there. And if you guys have any questions about this as we go forward, you can always call me or text me. We're not going to get them during the show, but I will see to it that Angela gets your information. She can call you back and get those questions answered for you. So, as always, 661-714-1400 is my number. We'll give out Angela's before the end of the show if you want to talk to her directly. But let's start with questions. We'll get into kind of your personal stuff. So Angela's got over 20 years experience doing this. Southern California resident, has been in the mortgage business just short of forever. And so she knows what she's doing. I think you guys are going to find this valuable. So a couple of questions. This is the one we get all the time. I'm going to skip over some of the easier stuff, like if I get a reverse mortgage, will the sky come falling in? No, it won't. But in your case, Angela, you're thinking, when does a reverse mortgage make sense? It's my favorite question that we were talking about, because it seems like it's very, it's kind of overall.
Yeah, it makes sense for someone who's planning for retirement.
Mm-hmm.
As long as you want to stay in your home for the rest of your life, if you're carrying debt or a mortgage in retirement, it's awesome to think of the reverse mortgage and planning ahead. Having conversations early is important. Not calling those 800 numbers, because the people that you're speaking to are not licensed. They are only in the business of maximizing company profits. So what happens is you call and they say, here's 200,000, and you're like, great, there's 200,000. Well, what's the plan with that money? Why are you going to spend interest on that from day one? I actually had a client who was talking to someone, and his son's all, wait a minute, why are you calling this 800 number? I know someone who does reverse mortgages.
Yeah.
I said, what's your plan with this money? He goes, well, I want to take $30,000 and do the roof, and then I want to put the rest in my savings account and pull from it $1,000 a month for my wife's long-term care policy. She had Parkinson's.
I feel bad for his wife, but that's a horrible idea. It's going to cost him a lot of money in interest, yeah?
I was all, why would you pay interest on $200,000 from day one? Why not? Let's split this up for you. Let's give you the $30,000 at closing. Let's give you $1,500 a month. By the time they are age 100, they'll have received $516 $1,000 versus just taking that 200 from day one.
Yeah, I like that you think they're going to live to 100. That's optimistic.
Right? Well, we are living longer.
I'm all for that. I'm all for that. But see, guys, this is my point. This is why I wanted Angela to come on and talk to you guys, because whenever you see, I'll put it this way, whenever you see an 800 number ad, a bus bench, television commercial, by and large, and I don't want to poo-poo all of them because I think you get some good information out of that, but you got to keep in mind the people you're talking to there are not necessarily who you want to talk to. I mean, I'll use the legal field, make fun of my wife a little bit here. I mean, my God, would you call the Law Brothers? We see their commercials all the time. I mean, maybe if I was in a big rig crash, that seems to be their thing. But I don't necessarily want an attorney handling my life if that's that important because they have their name on a bus bench. I want a professional. Now, if he's a professional and has his name or she has a name on a bus bench, that's fine. But you'll find in certain fields, and I would think reverse mortgages are certainly one of these, planning is such a big part of doing it right that you need to be dealing with somebody who, number one, is licensed, who has experience with this, and again is going to sit down and help you put together a plan. That's the idea. I'm like, well, this fellow, I can't imagine he was whatever interest rate he was making on the savings, never going to.
Oh my gosh, it was significant. 14,000 in the first year alone. I literally had to convince him that this was a better option. Now I'm going to make less money. I have 3 kids in private school. There's, if you want the 200,000, I can give that to you. However, my goal is to make that money last for you.
Yeah.
If he's her sole caregiver and he goes first, then what?
Yeah, there's, and this again, guys, is what it always comes down to. It's planning. That's everything. And you may find that a reverse mortgage is not part of what you need to do, although I think in most cases you'll find that it is, because in Southern California it is what it is. This is a fun statistic I pulled this morning. It's hard to get data on this. The amount of people in Southern California in particular who have paid off houses by the age 65. I would think that'd be easy data to get, but it's really hard. And I'm not terribly crazy about my source, but near as I can tell, in most of the country, about 85% of people who reach age 65 have a paid off home.
That's a large number. Wow.
It's a big number. However, in Southern California, and again, I'm not sure about these numbers, so don't quote me on these, but apparently it's 55%. Now, that has not been my experience. Mm-hmm. Most of the people that I meet, whether they come in crisis or not from my office, over the age of 65 don't have their house paid off.
Correct.
Sometimes they're about a 50-50 ratio, something like that. Maybe they're 60-40, equity, so that's okay. So it's a little bit harder here in Southern California because you're still going to typically have a mortgage payment. With our prices, what they are, you're probably have a pretty stiff mortgage payment even by the time you still reach age 65, which is another reason to look at a reverse mortgage.
Exactly, especially with the values being so high right now. Yeah. The chances are that you have a mortgage payment going into retirement, but you also don't have the old style pensions or additional income to help support that as well. So a reverse mortgage can help essentially put your mortgage payments on pause and potentially give you access to more equity. I like to call it the rainy day fund.
Sure, because it's there for you. Actually, that's a good segue to this. We had a client, a lot of clients actually. I'm sure you remember Countrywide. Mm-hmm. We all remember Countrywide. And for those of you who don't know, Countrywide was the biggest loan originator up until about 2008 that the world had ever known. And they were run by a guy named what was his name? Mozilla. It was his last name. Anyway, he sold, quote unquote, sold or let BofA take over his company as it was going down the tubes. Had a lot to do with the mortgage crash of 2008. They had every bank participated in this, them more than most. And there were a number of people that I had clever clients because they had a huge campus that's now BofA over in Simi Valley. And when they went under, they took a lot of pensions with them. Mm-hmm. So I have a number of clients who thought they had plenty of money in their pension to fund their retirement, and it all just went away, which made reverse mortgages a much more palatable option for them because their other option was sell your house and try to live off of someplace, whatever you can get out of it. And that's just not a very good idea. So let's get into all these questions. I get excited about talking about this stuff, but I want to make sure we start. I think this is a silly question, but I was going to cross it out when you said this is a question we should talk about, because I think it's just so silly on its face. And then no sooner did I say that than a friend of mine called and I said, "Hey, we're going to be doing reverse mortgages." And she said, "Oh, ask her this." Oh my God, really? No? You're a friend of mine and you don't know this already. Okay. Does the bank own my home? Can they take it away if you have a reverse mortgage?
That is the biggest question and the biggest fallacy that I come across all of the time. You still retain ownership to your property. The bank is not on the deed of the mortgage. They're not on the title. You retain full ownership. You can sell. You can refinance at any time. Yeah. Anything that's left once the reverse mortgage is paid off, it goes to your heirs.
Yeah, it's a lien. It's a note against the property, just like any other mortgage. Now, a reverse mortgage functions differently than a regular mortgage. But as far as the title to your house, what you can do with it, the taxes on your house, et cetera, et cetera, et cetera, that is all the same. There's the state of California. I mean, there's a slight difference because there are protections that come with especially the HECM. I love saying that word. It's just a silly acronym.
Home equity conversion mortgage.
Oh, there you go. Especially with that's the vast majority, like 99% I was reading of all reverse mortgages these days. So, and they're safe. They're done through FHA. So the bank just can't take your house. Now there are rules you have to follow, just like any mortgage. So, like if you were to say, if I got an FHA loan, could the bank take my house? Well, not if you make your payment on time. If you don't make your payment, yeah, they're going to come take your house. That's what happens. House is collateral. You got a loan. You don't pay it, you're going to lose your house. Now, we stand in opposition to that, obviously. We get these things worked out for people all the time. We do foreclosure defense. We do it for free, and we're good at it. Saved a lot of houses. Already saved about a half a dozen just this year already. We're not even a month into it. So, but no, they can't just take your house. It doesn't quite work that way.
There are rules, though.
Of course. Of course.
So the first rule is this must be your primary residence. You can't get a reverse mortgage and then move out and go live somewhere else. You also have to maintain your property charges, the taxes, the insurance, anything that would cause an additional lien to show up on title.
Homeowners associations.
Exactly. HOA, flood insurance. You want to make sure that these property charges are maintained, and then of course that the property itself is maintained. The city can't come and slap a condemned sticker on your window. So just please make sure that, if you are considering a reverse mortgage, that this is a property you're going to stay in for a while. Yep. I don't recommend it if you're going to leave in the next 3 to 5 years.
Yeah, exactly. And that's, again, why I wanted to bring Angela in with you guys. I keep coming back to the same thing. It's planning. And you have to be able to sit down with somebody who is not just taking their own short-term needs, i.e. commission, into effect. What they're most concerned with is what are your long-term needs. And by the way, for those of you who are in the industry who listen to the show, thank you very much. I appreciate it. That's also the secret to how to have repeat clients and how to represent whole families generationally. Because if you focus too much, in my experience, if you focus too much on the one deal and your commission, that is a good way to only have that client ever one time, if that. Because people know. Whereas if you put their needs above your own, which we all take an oath to do, which you're supposed to do, then they'll come back again and again and again and again. I had a client in the office this week I had not seen or talked to in 27 years. She just came in out of the blue. They were having a problem. Was happy to help them out with it. The weird part was her son is 29.
Oh, wow.
Last time I saw him, he was 2.
He was 2.
I am not old enough to know people this old. Oh, my God. I did start doing this when I was 19, so give me some slack. I'm 52 now, so it's not that bad. But anyway, my wife is still older than I am. Anyway, but she's also smarter, better looking. Don't get excited. No, she's fine. But anyway, so I want to unpack that section a little bit more, because this is where the problems come in mostly with reverse mortgages. If you do not follow those rules, if you do not pay your taxes, if you do not pay your homeowners association, if you do not pay your insurance, which is the single biggest bugaboo we see, then you're going to wind up in foreclosure. Now, there is a reason that there's so many, the number for foreclosures, and I don't mean foreclosure like they took the house, I mean foreclosure like they put it into foreclosure. Is so much higher with reverse mortgages is because those rules don't get followed, or they don't get followed properly, not by the homeowner necessarily, but by the bank. One of the little ripples in that rule, and it's easy enough to fix if you have this happen, is if you're in a gated community. They're supposed to, if they decide that you're dead, banks do this sometimes, they decide that you're dead, and so they decide to put the house in foreclosure because you're dead. Because they send you a form, you're supposed to fill out the form and send it back, and we've talked about that before, I won't go over it again, but we don't need to do that. But anyway, they don't have to go beyond the gate to the HOA. And yet that still counts to check if you're alive. That's nonsense. Now, the good news is reputable banks won't do that. They'll say, well, okay, we'll try calling, we'll try doing other things which you're supposed to do as well. But the Carringtons of the world and the PHHs of the world won't do anything. The good news is if you get that, ask for the report. Because they will send you a report and it'll have pictures of the guard shack and the gate, and it will not have pictures of the house like it's supposed to. And you can go to them and say, look, you never went to the house. How dare you suggest that this client is dead when you never bothered to knock on the door? And that is what the statute says. You're supposed to knock on the door. Well, we sent him a letter. Oh, I'm sure you did. Did you send it certified? No. Oh, well then, okay, sure, that's fair. So this is the kind of nonsense that we see. But again, if you do what you're supposed to do properly, if there's been some planning, it's very easy. I am still alive. Please take my house out of foreclosure. Job done. And then reverse all the foreclosure fees you slapped on me. Job done. Same thing with paying your taxes or insurance. If you pay it and they say you haven't and you say I have, then you're not in any trouble. They can't do anything about it. Or better yet, if you get it impounded, you don't have to worry about it.
Yes. So with the reverse mortgage, you can get and I'm using air quotes here, impound account. It's actually called a life expectancy set aside. It is not for the life of the loan. It's only good for like 12, maybe 14 years, and it will significantly take from the funds that that are available to you. So these are things, these are things you want to consider up front. I provide an amortization table. I provide a huge presentation. I do a video going over it so that you can stop, play, rewind, send it to your children.
Excellent.
And, you know what to expect from day one. And then we can also, we can tailor it. There are no two reverse mortgages that are alike. They are not cookie cutter loans. What works for one doesn't work for the other. And my goal is to ask you the questions that make the most sense, to make sure that we structure this in the best way possible to make that money last and to make sure your needs are met. If your concern is leaving a legacy, then let's make sure we look at a product that leaves equity for your heirs.
Yeah, and for those of you listening, amortization schedule, we use them all the time. It's a very fancy way of just saying we're going to plot out what, if you make the payment on January, this is what it looks like in February, what it looks like in March, literally month by month by month, so you can see exactly what is going on with the loan, exactly what all the numbers are. It is the roadmap. I mean, it is the most accurate roadmap you can get to any mortgage product. I think they're particularly useful when it comes to reverse mortgages so that you know exactly where you're at.
Exactly. And because there are no required mortgage payments, you will see how the interest accumulates. Now, you can choose to make payments at any time. You can make one payment of $500 one month and not another one for 18 months. Nobody's going to call and say, why didn't you make another payment, or what happened? You can make another lump sum payment if you hit the lottery. You can pay off the loan. So you have the freedom and flexibility. You are in control on how much the interest is accumulated, etc. But we, again, have all that conversation up front so that you're prepared.
Yeah, and guys, I did this with my mom. And those of you who know me, who know my mother, sitting down with her to go over numbers is a painful, painful exercise. Liberal arts major. But she understands numbers on a page. I mean, that's the whole point. It's not hard to figure out, would you rather have more or less? Well, more, please, especially if we're talking about money. Would you rather spend more than less? Less, please. And that's how you get that done. You look at the numbers on the page. That is kind of the whole idea. All right, we'll squeeze in one more question. We'll go to break. So we'll have to answer this one quickly. With rates being so, another one we got. With rates being so high, should I wait to get a reverse mortgage?
No. The reason you should not wait, the reason you shouldn't wait is because you should take advantage of that high interest rate. The interest rate actually derives the growth rate of the line of credit. So for instance, if the rates are in the 7s, the growth rate of the line of credit, the more access to funds that you're going to get in a particular time. So for instance, most of the line of credits will double after 10 years of unuse. So what I do is I tell you, you know what, keep this as your rainy day fund.
Sure.
If you have an emergency, dip into it. If not, pretend it's not there. In 10 years, that $150,000 is now $300,000. So, I would take advantage of those high rates. And then of course, as the rates improve, the HECM product, the home equity conversion mortgage, is an adjustable rate. Don't let that scare you, because when the market improves, so does the interest rate.
Yeah, and if you really hate it, you can always refinance if you need to. Again, it's just a regular loan. You can always refinance. You can refinance one, and we've done this many times. You can refinance with clients. You can refinance one reverse mortgage with another. If we had somebody come in right at the beginning of the pandemic who had an interest rate of like 7%, which is what you on their reverse mortgage, and rates had dropped to like 3 at the time. So go. Job done. Just go refinance it.
Absolutely.
Default taken care of. You get more money out of it. You're costing you less to do it. It's much, much better. So, I tell you, I see we're at about that time. So let's take a break. Let's go hear from some more of our sponsors. We do love it when we listen to the sponsors. So please listen to the commercials. I like commercials. I like good commercials. I'll put it to you that way. I like commercials that entertain. But anyway, entertain or inform. Anyway, so let's take a break and do that. When we come back, we're gonna have Angela stay through. We promised her she could stay through because there's a lot more to cover. We're gonna get through the first 3 questions because it's a big topic, and that's why you need to talk to somebody who knows what they're doing. That's why we're recommending Angela. So stay with us through the break. When we come back, more with Angela Wyckoff about reverse mortgages. Thanks, guys. Hi, guys. Thanks for listening through the break. Welcome back. I'm your host, Rich Sherman. You're listening to the Real Estate Fix on KHTS 98.1 FM, AM 1220, your hometown station. Also, your hometownstation.com. And for those of you watching on Facebook Live, hello, because we get video on Facebook Live, which is always fun. So I got a gig in radio, so I could be a video component. I'm so happy about that. Anyway, we're here with Angela Wyckoff. We're talking all things reverse mortgage. Angela is an expert in the field. She's been doing this for over 20 years. She's with Reverse Loan Solutions, which is a division of AmeriFund. And as long as we're doing identification, give out your phone number to them. Which number do you want to call? I've got several. So which number do you want to call?
Sure thing. You can reach me at 805-301-1933. That's 805-301-1933. You can shoot me an email, angela@reverseloansolutions.com, and check out my website, ilovereverse.com.
And if you guys didn't get any of that, if you're driving or anything you can call me anytime. I'll give you Angela's information as always. Just anybody we recommend on the show, obviously we always have their information at hand. We're happy to give it out because that is the whole purpose, is to fix your problems and be a resource for you. So please call anytime. And even if you don't listen to the show and somebody else has told you about it, call me up and tell me you listen to the show. I will still believe you. We do still like that. So anyway, so let's move on. Next question. One or two more questions. We'll get into some general stuff. So let's see. What if values go down? Will that take away my access to funds?
It will not. The happiest people on the block were the people during the mortgage meltdown that had a reverse mortgage. Everybody's values went in the tanker.
Dropped off 50%.
Yep. And the HELOC lenders turned off access to funds. That happened to me personally. But everyone who had a reverse mortgage still either received monthly payments, which we can, talk about that too if that's something you're interested in. They had access to their funds. Whatever they set up from day one was set in stone.
Because again, it's a lien against the property. The loan is set up ahead of time, and the lender has to conform. Just like you as the borrower have certain rules you have to follow, so does the lender. So they can't just say, like with a HELOC, they have the ability to turn it off. But with a first lien with a property lien with a reverse mortgage, they don't.
They
It's
can't,
there and it's just as there. That's the rules.
That's why you pay a 2% mortgage insurance premium. So a lot of people say reverse mortgages are so expensive. Well, let's talk about expense versus value. For instance, let's say your property's worth $2 million or $1 million. So your 2% is the $20,000 of the mortgage insurance premium. So this is a financed fee that is collected at closing. So your mortgage balance starts out at the $20,000 plus whatever the finance closing costs are. If you set up a line of credit, then whatever you use from the credit goes from the credit column into the balance column, right? So if you don't use, you don't pay interest on those funds. The reverse mortgage cannot be turned off because you paid that insurance premium up front. Now, let's say, for instance, you set up payments or you used all of the money in the line of credit, and now your balance is starting to grow at a faster rate. Let's say your balance exceeds the value of the home. Now you're upside down, right?
That's everybody's dream. I think that's what everyone wants.
Right?
They all want their balance to exceed the value of their home if they don't have to give, if they don't have somebody to leave it to.
So let's say your balance, I'm just going to pick some ostentatious numbers. Let's say it's now $3 million and your property value actually goes down to $800,000. Who's going to pay for that deficit?
I know the answer to that question. You're asking me. Your mortgage insurance premium is going to step in.
Exactly. So that is a protection. That $20,000 helped with that, $2 million deficit?
And by the way, those of you listening, you're going to have a mortgage insurance premium on any loan product that you put less than 20% down. That's why you hear people say all the time, you should put 20% down when you buy a house. And I agree, if you have the 20%, do it. But in Southern California, that is, especially for first-time buyers, that is a rare thing. So most of the time you're looking FHA, which is 3.5% down, or 5% down conventional, or even 10%. And in that scenario, you're going to pay a mortgage insurance premium regardless on the type of loan. So they are not unusual. It is not something specific to, oh my God, I'm paying all this. It's not something that is unique to reverse mortgages. Now, the way that the insurance is structured is reverse because is tailored to reverse mortgages because they're reverse mortgages. When I go put tires on my car, they have to be the right size tires, otherwise my car doesn't run right. So the mortgage insurance premium for reverse mortgages has to be a reverse mortgage insurance premium. And you can also get rid of it on a regular house, depending on what it is and where it is. With FHA and government loans, it's baked in. You're stuck with it. If it's an independent mortgage insurance, sometimes referred to as MI or PMI, you get it to about 20%. There are ways usually to get rid of it depending on the time and depending on who the MI company is. And reverse mortgages have them baked in if you choose to do that. But again, it protects you. That's the idea. Because with a reverse mortgage, your balance is going up because you're getting the money out of it. Whereas with a regular mortgage loan, for lack of a better description, your balance is going down. So you're putting money into it. So getting rid of MIP, mortgage insurance, in a standard loan makes good sense. But in a reverse mortgage, I think you kind of want it because that gives you the ability to go over the value. That's why the reverse, and you also have no choice. That's
right. I was just going to say
one
that.
Of the rules. But that's why it works that way. So I'm not a fan of having extra money in a deal. I'm not a fan of giving banks money if I have a choice. But it makes sense. It's necessary because that's what makes the train go down the tracks. Because without that, you couldn't do reverse mortgages. So, right. So those are lots of questions. I see we have just a few more minutes left. So I want to get into some other stuff with you a little bit. Because I know you and I have talked about it, and I think it's important you share this. And I've heard you share this on other radio shows and stuff. As I was talking about, I'm very lucky in that I have a radio format. I do other things. Everybody wants to be sort of on our dance card for who we recommend to clients. We have a pretty large clientele base. So we have a lot of people to recommend. And I've had a lot of people come to me over the years who said, hey, we do reverse mortgages. Rich, you should recommend us. And I usually, okay, and I'll talk to them about it. I'll look at it a little bit. And never once have I had that conversation with a reverse mortgage lender where they were telling me what they could do for the client or what their process was for the client. not, I mean, we get to that point, but it always starts out with usually what's good for me, which I don't need to hear, thank you very much, or what's good for the reverse mortgage lender I'm talking to. And in Angela's case, is really the only time this has ever happened, so I was so anxious to have you come on. I really was kind of ridiculous about it. Please come on the show. I also didn't know you had all kinds of radio experience. So we spent 20 minutes me going, oh, that'll be fun. It's easy. Oh, don't be scared. Oh, it's fine. Only to find out she's got more radio experience than I do, which I thought was hysterically funny. So thank you for letting me prattle on like that. I appreciate it. So you also know she's patient. I didn't mean to test you like that. It just didn't work out that way. But the point is, the first time we talked about reverse mortgages, your first response to me was, here's why it's good for clients to do this. And I knew a lot of the rules and stuff. I was pretty well educated. Not as well educated to it as you are, obviously, but I know a fair amount. And I was just very, very impressed. That's kind of where your head's at. And I think, as we've talked about all day today, that is the single most important thing. It's true with realtors, it's true with lenders, it's true with any lawyers, it's true with any specialty. Where you're hiring somebody, you're going to pay them a fair amount of money to do a job for you that if done right, your life goes on and it's good. And if done poorly, it's going to damage your life. It's that important. So I finally found somebody for you guys that actually, puts you ahead of them. And I've seen that. I've talked to other people about you as well to make sure. I don't want to fall on my face making this recommendation. And that's what I hear from everybody. It's like, well, yeah, Angela, you want to talk to, and this is why. As a matter of one of my friends said, oh, you found Angela. You found Angela. There was a treasure map? Why didn't you tell me this ahead of time? You could have saved me a couple of years worth of work. Thank you very much. Oh, yeah, no, she's great. Oh, well, good. So your peers think well of you as well. So that's why. So I wanted you to, in our last minute here, if you could really briefly tell that story about why you got into the reverse mortgage business, how that kind of led you here.
Absolutely.
Just real quickly.
Yes. When I was about 13, we had to move into my grandmother's house. So we had 4 generations. My grandmother was the caregiver for my great-grandmother. And it was my mother and myself. Mm-hmm. Now, my great-grandmother was bedridden, so my grandmother, my 4'9" grandmother, was her sole caregiver, and she struggled to care for her. And she finally got to the point where she physically couldn't do it anymore. And she had to send her to a home. Problem was, it was in our city, so we constantly went and visited her. It was cold. It was like walking into the Costco freezer section,
it's a
right?
Human warehouse where people wait to die.
Exactly. And then she would be screaming that they're trying to poison her, etc. And, had we had a reverse mortgage, we could have kept her at home and brought care to her. Yeah. It would have been a much better end-of-life experience. And so I've made it a mission to help seniors. I don't want to see anybody have to go through that again.
Yeah, no, my mother-in-law was in one of those things. We broke her out for Thanksgiving and never brought her back.
Awesome.
We just left. We still have the wheelchair. So I wanted you guys to hear that story before the end of the show here, because that's kind of where her head's at with this, and it really is. I've been to her house. I'm telling you, it really is that way. So thank you guys for listening. It's been a great show. I really appreciate it. Hope you learned about reverse mortgages. If you have any questions, feel free to give me a call anytime. I'm at 661-714-1400. I'm Rich Sherman with Radius Agent. I'm your host of The Fix with Rich. Thank you guys for listening. Have a great week. Be good humans.